Welcome to Business Decoded, where we break down how companies really make money. Let's decode today's business model. Uber loses money on every ride. The core business that built the company bleeds cash. But Uber Eats, the food delivery side, prints money. The same company has two opposite business models. One subsidizes rides to keep drivers on the platform. The other extracts profit from restaurants who can't afford to leave. Uber generated $37 billion in revenue in 2024. But rideshare margins are razor thin. Take rate is 25%, but costs eat it all. Uber Eats has a 40% take rate with lower costs. Food delivery is more profitable than taxi rides. By the end of this video, you'll understand why Uber can't make money moving people but profits from moving food, how the same driver network creates opposite economics, and whether Uber will ever turn rideshare profitable. Before we begin, a quick disclaimer. This content is for educational purposes only, not business or legal advice. Company references are from public sources for educational commentary. Trademarks belong to their owners. Consult qualified professionals before making business decisions. Here's how Uber actually makes money. Uber has two main businesses: rideshare and food delivery through Uber Eats. Rideshare generated $20 billion in gross bookings in 2024. Uber Eats generated $17 billion. They're almost the same size but completely different economics. Rideshare works like this. A passenger requests a ride. Uber matches them with a driver. The passenger pays $10. Uber takes 25% or $250. The driver keeps $750. Sounds profitable. 25% take rate should generate massive margins. But it doesn't because of driver incentives and insurance costs. Uber pays drivers bonuses to stay on the platform. Quest bonuses for completing a certain number of rides. Surge pricing passes most of the extra revenue to drivers. Promotions for new drivers. All of this cuts into Uber's take. In high-demand areas, surge pricing can triple fares. But drivers get most of that surge premium. Uber's percentage stays roughly the same. On a $10 ride that surges to $30, the driver gets $23, not $750. Uber still takes around $7, not the full 25%. This is necessary to keep drivers online during peak demand. If Uber kept the surge premium, drivers would go offline and take higher-paying gigs elsewhere. Surge exists to balance supply and demand, not to increase Uber's revenue. After driver incentives and surge pricing, Uber's effective take rate on rides is closer to 15%, not 25%. On a $10 ride, Uber nets $150, not $250. Then there's insurance and safety costs. Uber provides insurance for every ride, background checks for drivers, customer support for disputes, safety features and technology. These costs add up. The result is rideshare operates at break-even or slight loss. Uber doesn't lose billions annually anymore like it did pre-2020, but rideshare itself isn't profitable. Why does Uber keep subsidizing rides? Because rides keep drivers on the platform. And drivers are needed for Uber Eats. Uber Eats is the profitable business. Here's how it works. A customer orders food. Uber charges the restaurant 30% commission. Uber charges the customer a delivery fee and service fee. The driver gets paid from both pools. On a $25 order, the restaurant pays $750 in commission. The customer pays $3 delivery fee plus $2 service fee. Total revenue to Uber is $12.50. The driver gets paid $7 for the delivery. Uber nets $550. That's a 44% margin before operating costs. Uber Eats has better unit economics than rideshare because customers and restaurants both pay. In rideshare, only the passenger pays. In food delivery, the restaurant pays commission and the customer pays fees. Restaurants hate the 30% commission, but they can't leave. If they're not on Uber Eats, they lose access to millions of customers. Customers order through apps, not by calling restaurants directly. For many restaurants, Uber Eats represents 20 to 40% of total revenue. During COVID, delivery kept restaurants alive. Now they're dependent. Pulling off the platform means losing that revenue overnight. Small restaurants have it worse. They lack negotiating power. McDonald's and Starbucks negotiate lower commission rates, sometimes 15 to 20%. Independent restaurants pay the full 30%. This creates a two-tier system. Big chains with volume get discounts. Small restaurants subsidize the platform. It's regressive, but restaurants have no choice. This creates a stranglehold. Uber Eats has market power. DoorDash is the competitor, but both charge similar rates. Restaurants are trapped paying 30% to both platforms. Uber's strategy is to use rideshare to recruit and retain drivers, then monetize those drivers through Uber Eats. Rideshare is customer acquisition. Uber Eats is monetization. This only works if the same drivers do both. And they do. 60% of Uber drivers also deliver food. They toggle between ride requests and food orders based on demand. From Uber's perspective, it doesn't matter if a driver is moving a person or a burrito. Both keep the driver active on the platform and available for the next request. But burritos are more profitable per delivery. Uber also has Uber Freight for trucking logistics and other smaller ventures. But 95% of revenue is rides and food delivery. Uber's path to profitability required cutting subsidies to drivers and riders. Pre-2020, Uber was losing $5 billion per year. They subsidized rides aggressively to gain market share. Post-2020, Uber cut subsidies. Prices went up for riders. Driver bonuses decreased. The focus shifted to profitability over growth. In 2023, Uber posted its first full year of profit. The company made $1.9 billion in net income. This came from Uber Eats scaling, not rideshare becoming profitable. The business model has risks. First, regulatory risk. California and other states are pushing to classify drivers as employees, not contractors. If drivers become employees, Uber has to pay minimum wage, benefits, and payroll taxes. This destroys unit economics. Second, autonomous vehicles. If self-driving cars work, Uber doesn't need drivers. But Uber doesn't own autonomous vehicle technology. Waymo, owned by Google, is ahead. Tesla is ahead. GM's Cruise was ahead before shutdown. Uber partnered with these companies to integrate autonomous vehicles into its platform. Waymo cars appear as Uber options in some cities. But this makes Uber a middleman. If Waymo decides to launch its own app, Uber loses the customer relationship. Uber's value is the driver network and customer base. Autonomous vehicles eliminate the driver network. If AVs also eliminate the need for Uber's platform, the company's entire moat disappears. This is existential risk. Third, competition. Lyft competes in rides. DoorDash competes in delivery. Both are well-funded. Uber has scale but no insurmountable moat. The bull case is Uber becomes the dominant platform for urban logistics. Rides, food, groceries, freight, everything moves through Uber. Autonomous vehicles reduce costs. Uber owns the customer relationship even if they don't own the cars. The bear case is Uber remains a low-margin logistics broker. Autonomous vehicles disintermediate Uber. Customers order directly from Tesla or Waymo. Uber's value proposition disappears. For drivers, Uber is a flexible income source but not a career. Earnings after expenses are often below minimum wage. You're an independent contractor with no benefits. For riders, Uber is convenient but expensive. Surge pricing during high demand can triple costs. Taxis are sometimes cheaper. For restaurants, Uber Eats is a necessary evil. You pay 30% commission to access customers. If you don't participate, competitors who do will take your business. Here's what to do. If you're a driver, track your actual earnings after gas, maintenance, and depreciation. Most drivers overestimate net income. If you're a restaurant, negotiate commission rates or build your own delivery system. If you're a rider, compare Uber to Lyft and taxis. Prices vary. Now, next time on Business Decoded, we're examining Airbnb. They own 0 hotels but beat Marriott's profit margins. How does a company with no real estate generate 40% margins? Uber loses money on rides but profits from food delivery. Rideshare has a 25% take rate but driver incentives cut it to 15%. Uber Eats has a 40% take rate with lower costs. Restaurants pay 30% commission. Customers pay delivery fees. The same driver network creates opposite economics. Uber's profitability came from scaling Uber Eats, not fixing rideshare. Whether Uber survives long-term depends on autonomous vehicles and regulation. And that's how they built it. If this helped you understand business better, subscribe for weekly deep dives into the world's most successful companies. Thanks for watching.